That's a very good question, and I would try to answer it as simple as possible. That the earlier you start in life, the any financial planner will tell you that you need to start saving and planning for your finances as early as possible. We call it the compounding effect, because a small amount of money, if you start saving early, it can really help you achieve a number of goals. So the best time is to start early. We still see that for young people, they do not purely understand the concept of insurance as much. So most of the customers, once they have certain amount of money, they start thinking about insurance. But this is something where as soon as people start working, they can start planning for retirement. We know that there isn't a very strong social security system. So that is where insurance comes in. When you add members in the family, you have a dependent, you need to see how to protect the dream of your family, how to make your wife financially secure. So that is where insurance comes in. When you have kids, you may have goals like education for your kids. These are all long term saving. You cannot put money aside when you are about to retire. You cannot start to arrange for money when your kid is going for higher education. You cannot, think about when and how to leave money behind for your family if something happens to you. So you have to start thinking about it as soon as you have an income. And that's why I strongly recommend for all the young people to start thinking when to buy insurance. There are simpler insurance products which are now available, even for the health cover. When people start to work, there are so many young people in the gig economy, as we call it. They don't have steady, regular employment. They don't have corporate insurance cover. If they go to a hospital, they may need something like a basic room and board cover that an insurance company can give them some money. So there is a wide range and gamut of products which are available depending on how your income is. You have to start small, but you have to think about how to start financial planning, and then insurance will always be in your mind because it's a very, very critical part of financial planning.
Uh, so what is that your suggest? Which one? The young people choose the unit link product or the traditional product for insurance?
That's a tough question to answer, but I will try to give you some examples. Now, if you are planning anything which is 10 or 15 or 20 years over, in my experience, and I have worked in India, Vietnam, Thailand, and now in Indonesia before this, and I see mostly in all emerging market, over 10 to 20 years, the equity markets give a better return than what fixed income or government bonds will give you, because these are economies which are growing, and as economies grows, the companies which are listed create a lot of value. So if you have something which you are planning which is long term, unit link could be a very good option for you. But if you have something which is more specific, let's say if your kid is 5 years or 8 years old, and at 18 you need an endowment, a fund which you are very clear that you need a billion at the time when your son or daughter will be going for education, then you want that certainly, and you have a clear date that when you will need it, then you may look at a more traditional product. So as I said that, the advice is very, very critical. How customers get guided, how do we understand what are the financial goals of the customer, and then there is a suitable product for the customer. So I have given you an answer which says that in which circumstance a unit link may be good, and in which situation a more traditional product may be needed. But I think it's all about suitability